The Hedgeless Horseman here. It's April the 2nd, 2024. This will be my first video in a couple of weeks, I think. I haven't really felt that I've needed to do any copium videos, given that gold and well, especially gold and also silver a bit has been pretty much on a tear recently. So it's not like I don't think that a lot of people needed a lot of encouragement to, let's say, buy the cheap juniors, etc., etc. So I've been doing other stuff, doing a lot of due diligence, on First Nordic, for example. But anyway, first of all, thanks to the sponsors. Look at the markets. Commodities are doing well today as well. Gold is up. Silver is up a bit. And so weird with silver. It's like you read, 2%, and then it's like half a dollar. It doesn't sound like too much, but if you look at silver, I mean, it's quite close to breaking out, and especially the way silver acts. I mean, when it goes, it typically really goes, or can really go, and I mean, I don't think you need to be a major chartist, let's say, to see that, okay, there might be, something might happen if we break this for real. I mean, you can, I guess, draw lines anywhere, I was gonna say, but I mean, you see this kind of behavior, okay, sort of similar. Once it breaks, whoop, then we had the COVID flash crash again, of course, but then when it broke this straight up and stuff, and you see this, I mean, quite frequently, I was gonna say. Typical, let's say, silver consolidation, whatever, you can draw lines in a lot of places, I guess, where it's like when it actually breaks through, it just rips, and I'm assuming that's a lot due to short covering. There's like, okay, people short, assuming it won't go higher, or hope it won't go higher. When it actually does go higher, the ones that are short go like, oh crap, and then they start to cover, so they have to buy silver to cover their short position, and then it becomes jet fuel, basically. But everyone will have a different take on this, and I mean, the more time I spend in these markets, the more I get convinced that I think, for me at least, what works best is not caring too much about charts, let's say. I mean, there's people every day, you're gonna get bombarded by people that say gold is gonna crash, gold is gonna go higher, and if it goes higher, you might see like, oh, it's gonna go here, and then it's gonna drop there, so then you're like, oh, okay. You're already fearing something that hasn't happened yet, like, oh, it's gonna go up. Well, this is silver, but you get my point. It's gonna go up here, and then it's gonna retest and all that. I focus on the obvious things where I can't really get it wrong, in a sense, and that's, buy cheap, sell when it's not cheap. That's the most straightforward way I know how to invest, and because then it doesn't really matter what the chart says, it doesn't matter what the rates are, it doesn't matter what inflation is. Yes, all of that is obviously gonna play some part, especially inflation, given that it's since 2020 when we got our inflation. I mean, it squeezed the margins, but hey, I mean, juniors especially are cheap in absolute terms and relative terms and all that. I mean, nobody can look at some of these, especially the decent to good juniors, and say, wow, they're overvalued. It's like, why? What? I mean, they're the cheapest they've probably ever been relative to gold, even when you include the inflation, whatever. Gold is at 22.70 or something. I mean, it's absolutely ridiculous that the gold juniors are trading like none of them really have a shot at being monetized, having a gold mine that actually works. Especially again at today. I mean, almost every project would probably make sense to build today. Right now, I mean, that might change quickly, of course. Because let's face it, I mean, gold above ground is at all-time highs. Gold in the ground is near all-time lows. And especially if you consider, okay, what's the profit margin of the gold in the ground right now at 2270 gold? That's probably very high. Probably, some of the highest margins, in quite some time. They're not reflecting that at all. So gold in the ground is, I don't know. I don't know how cheap gold is. I don't know how cheap silver is. I mean, physical silver and gold. I don't know, because there's no straightforward metric to use, right? Some say, well, if you look at how much money printing or the deficits or whatever, it's like gold could be, if you go by the reversion to the mean and account for the fiscal deficit or money printing, gold should be at $10,000 or something. Maybe that's true. Maybe gold should go up 5 times in the future. But what I can see is that the gold companies are cheap. So that's what I'm focusing on. I have no idea where silver is going to go in the short term, whatever. I know that the junior sector is unsustainably cheap. And so there's a bunch of, I thought I would start with this. I mean, I just do some drafts now and then, just, to basically collect my thoughts, because there's so many concepts to talk about. That's why my videos typically become so long. I mean, I'm trying to hammer home, repeat myself a lot by hammering home, my investment philosophy at least, and that's why it's like you shouldn't be selling cheap ever. I mean, if you sell cheap, you deserve to lose in any time frame. If you're a value investor, because that's the only metric you should be using. If it's cheap, it's a buy. It's not it's cheap if or it's a buy if it's cheap and the short looks like this and CPI is like that and the Fed has said this about rates or whatever. No, if it's cheap, especially today when it's like cheap regardless. I mean, the juniors are if gold fell by $500 tomorrow, the gold juniors would probably still be very cheap. That is just unheard of in terms of margin of safety. It's absolutely ridiculous. But we've also seen, it's like, okay, if we think the gold juniors, gold in the ground is cheap, is there evidence of anyone that might be smarter than us that thinks so? Yeah, I mean, basically every billionaire is pounding the table. McEwen recently, it was announced that he invested in another Canadian gold play, Alamos Gold, which is one of the best performing mid-tier, so one would think, hey, they're actually smart. They are actually one of the few, let's say, mining companies that knows, let's say, what value is. They buy when they should, if you know what I mean, when it's cheap, and they buy. I mean, look at the acquisition of Richmond Mines. This was a few years ago, but I mean the Island gold mine. I mean, they made a fortune on that one. So that was a really good buy. I mean, it was probably worth in the end, or as Almos has shown, worth a lot more probably than what they paid for it. And that's what I like to see. It's like even miners, given how hard this business is, they're buying stuff and they're not buying trading sardines. And still they can have, make purchases that prove to be, this should be, was worth a lot more than we bought it for. So they bought, who did they buy before? They bought Manitou Gold, which is in Canada. pretty close to their operation. More recently, they bought Argonaut Gold, and that was basically at 3-year lows. So again, it's like, I mean, they're not stupid. They're not just out there like some gold companies that they only buy the tops or whatever. They seem to be very good at value investing, which is a good sign that this sector is cheap, especially, you know, the ones they've been buying gold juniors in Canada. Caliber bought Marathon. That's in Canada as well. Marathon, one of the, you know, few good grade multi-million ounce deposits. It's no Snowline Gold, but still, I mean, there are simply not too many good projects around today. Rupert trying to buy out B2 from Orion in order to be acquired later, I assume. That's the largest undeveloped gold deposit in Finland. Well, I think it's the largest one undeveloped in Scandinavia. Again, it's like, and I'm gonna get to that here. I mean, gold is rare. Prime ground in prime jurisdictions, or, you know, prime projects in prime jurisdictions. That's extremely finite. I think there, again, it's like there might be, well, Mawson has a gold project, or they spun out a gold project in Finland. But it's like, there is one large undeveloped gold deposit that I know of in Finland. That's Rupert. There's one in Sweden. That's Barsela. We're talking one asset per country. And if you look at Canada, I mean, how many are there left? We know Snowline. There's also, you know, Banyan, for example, multi-million ounce, and there's stuff around. There is stuff around, but it's like, it's not that many. It's not like there's I mean, when accounting for like a real project, if you know what I mean. I mean, there's plenty of like large multi-million ounce low grade mines wherever. I mean, especially in Canada, where it's like a lot of the projects are remote, so it's hard to even put into production. That you need, you know, a gold mine needs to have like 7-8 grams per ton, whereas in other places, I mean, take Nevada, they're mining what, 0.4, 0.5 grams per ton open pit in Nevada. That works there, but it's like, does it work everywhere? No, it doesn't. I mean, even Nova Gold, for example, with its 20 million ounce resource in Alaska. I mean, that's quite remote, and that hasn't been built yet. Well, it's refractory and all that, but just the infrastructure and stuff. I mean, if that project would be located in Nevada, I mean, it would be built already. So let's go over a few things. I mean, there's stuff that's cheap at face value. You know, okay, what are you paying dollars per ounce here? And if you look historically, again, I mean, there's let's say a trading sardine out there where it's like, oh, it can trade from $100 per ounce to $20 per ounce. Let's say it's not really a good project. Well, let's say it has challenges, so it's not a no-brainer. This is for sure gonna get built anytime there's a, you know, a long line of suitors or anything like that. So at face value, it's cheap because it has tended to trade up to, let's say, $100 per ounce in a hot environment. That's one way, obviously, to make money, because most juniors are trading sardines, and that doesn't keep them from going up 500 to 1,000% from bottom to top. That's certainly one way to play it. And I've been saying this now for the last couple of months. I think that's like, I'm mostly focused on beta plays, margin of safety, not necessarily pure trading sardines. Although it's like, I think, and I've said that, it's like, look at the silver juniors, the silver betas. They're down 90%. You could probably buy 10 of those equally weighted, and you're gonna make money, because they're gonna go up No matter what the actual value of them is, they're gonna go up if silver gets going. But okay, I prefer non-trading sardines. Beta with margin of safety, but it's like, hey, these projects actually have some merit. Because, okay, part of the markets, in my opinion, is like you're not only front running other people, you're front running yourself as well. And I've said this a bunch of times. When gold and silver rips, I get FOMO for beta. It's like buy the largest resource, whatever. As soon, let's say the next day we have a flush in the metals, then I feel stupid all of a sudden. And are much likely to become uncomfortable, and it's like, oh, why am I sitting in this? I know this really doesn't have much value. It's a trading sardine. And then I start to fear, like, what if metals actually go down? What if they don't go anywhere and this company just dilutes itself? It can't really create any value, and who knows, there might not really be much value. Yes, they have a lot of ounces in the ground, but that's never going to be monetized. So in a sense, it's like they have no business. They have a business on paper because they have a lot of ounces, or they have value on paper. So I try to keep that in mind as well. But yesterday, for example, or today, when metals ran higher, of course, it's like, oh, I should be only in beta. It's like let's pile in. That's a pretty human response because it makes sense. If metals are rocketing, beta, trading sardines, whatever the even the worst of the worst, let's say, they tend to go up the most from bottom to top. It's just that I'm not too comfortable with that, and I'm especially not too comfortable talking about it because there's no long-term investment play. I mean, it's no real long-term investment case. It's you're playing the greater fool, and in that case it feels weird talking about it, knowing that's like, well, I don't really like to own this over the long term. I'm just I'm gonna pawn it off to someone down the line. But I try to be open with that, of course. But still, it's not that fun to talk about because you never know. It's like, when is it really a sell? We don't know if the cycle tops and they get $50 per ounce or $100 per ounce or $150 per ounce. If I'm in long-term plays where I think, hey, they can create value, then you don't really need to be that right in terms of like, when is the actual cycle top? Because if a company just keeps on creating value over the next 5 years, I'm just going to assume that, especially if you start to buy cheap, on average you're going to have a bigger profit for every passing year, assuming again they create value. Then you don't really need to be timing anything. You don't really need to be trading it. Like the Lundins, etc. They buy once, they sell once. Anyway, so it's like, yeah, okay, non-trading sardines, but hopefully with margin of safety. It's like, okay, what is actually value? Can this be monetized? There's a bunch of stuff, again, a bunch of juniors that have ounces on the books, but it's like, this is probably never, at least not in the next 10 years, gonna be developed. It's like, the 100th best project in the world or something like that, or even in a particular jurisdiction. But if something actually has a shot at becoming a mine having value, I'm much more comfortable buying that cheap, because that might actually be cheap from a business perspective, not only a trading sardine perspective. Maybe you pay up a bit for it. I mean, there's trading let's say a legit project with gold ounces or silver ounces in the ground trades for 50 million, and then you have one with even more ounces or similar amount of ounces, but it's trading for 20 at face value. The one that's trading for 20 million is cheaper, but in actuality that might be a pure trading sardine, that they don't really have a project that's worth much. So from an investing standpoint, that's cheap at face value, but the other one might be cheap, in light of real value or probable value. In that case, I'm more comfortable sitting on the one that I think I'm not the greater fool here in any way. This is cheap. This has a shot. This is probably going to be acquired one day. Even if it doesn't get acquired in the next few years, it still has value. And again, if it could create more value, that's even better, because the margin of safety is at least going to be climbing. Jurisdiction. And that's one thing I've thought a lot more about lately. I mean, I've pointed this out before. Tom Kaplan believes there's going to be a bubble within a bubble, that there's going to be a mining bubble one day, let's say gold mining bubble, and the assets in tier 1 jurisdictions are going to fetch a pretty hefty premium, simply because they are in a premier jurisdiction. I mean, I'm thinking when it's let's say real fear out there, or maybe again when there might even be a fear of need. Let's say COMEX has problems, like people can't really buy ounces above ground. Maybe the East is buying it all up, and so what do you do then? Okay, the next closest thing is buying ounces in the ground, and then the question is, if you're fearful, etc. I mean, probably you're gonna have the large miners see quite a bit, but still, if you're in juniors, where are you going to be most comfortable buying ounces in the ground if you're really fearful of things are starting to really crack in the financial system, and let's say we are approaching some kind of hyperinflation or whatever. I mean, this is not going to happen overnight, obviously, but I would probably be more keen to buy gold in the ground or silver in the ground in a jurisdiction where I know I get to keep the ounces. So I think that's not really in play now. It's like we've seen a basket of silver juniors trade down to almost the same market cap, regardless of the fact that they have different projects, different grades, different management teams, different grades, and in different jurisdictions. So due diligence, certainly, in my opinion, even though there's a lot of bias out there, I think, I mean, from a trading perspective or a real value perspective, I think it's just obscene how much difference there can be between a buy and a buy. Let's say you have two companies, they're trading at almost the same price, but one is in a much better jurisdiction, at least perceived to be, better quality ounces, better infrastructure, and they might still be trading at the same price, assuming they have, let's say they have at least around the same resource. But if you look under the hood, it's like, well, this one might be cheap with 50 million ounces of silver or something, but this one with better jurisdiction, better infrastructure, whatever, that should obviously demand a premium, but it doesn't, because nobody cares. Nobody cares about value, nobody cares about due diligence, because everybody's just been selling because it has the name silver in it, for example. That's an obvious opportunity, relative opportunity at least. Both might be buys, one might be a much better buy than the other, especially if we're front running again. It's like, okay, how could things change? Maybe we get real fear in the world markets. In that case, maybe the jurisdiction premium will start to show up. So if you're not paying for that, I mean, that's just another ace in the hole, basically. It's like, okay, that's a free option, let's say, that things go that way. So again, real estate prime ground is very finite. I mean, you look at some of these mining camps or whatever, especially the ones with better infrastructure. Because let's face it again, it's like Canada is huge. There's no lack of ground in Canada. There's a bunch of belts, let's say, in Canada. But it's not endless, it's not infinite. And especially the belts, let's say, or the areas where it's like, okay, it has prospectivity plus infrastructure, let's say, which is a big competitive advantage. That's much more finite. So I mean, my knowing myself is like, what am I mostly focused on now? what are my preferred plays? Like marginal safety, ounces in the ground that I buy for less than they're worth, and it has probable growth and potential growth, and has a shot, or either being already a legitimate project or could grow into being a legitimate project. Because in that case, it's like, if what I'm buying right now, based, what they've already de-risked, if that should already be trading at 200% higher, and they have a chance of, let's say, doubling the value at least over the next 3 years, then in my view, it's like, okay, I have a probable 200% returner here. Or I'm buying it for at a 67% discount, just based on what is known. But if they can double that, I mean, okay, it shouldn't go up. Maybe, well, I probably have 200%, but maybe that's more closer to 400% within a few years, etc. And if it can grow for 5 years, maybe what I'm paying today is going to be 1/10 of what it's actually worth in 3 to 5 years. In that case, it makes it a lot easier, in my opinion, to just hodl. Whereas a pure trading sardine, you're like, okay, maybe this is kind of cheap at face value. I expect, let's say, 300% at least when the cycle swings. But they won't be creating much more value. It's not actually maybe that valuable right now, but you're only playing the trading sardine part. That's obviously not as comfortable to hold over the long term, because that might be a loser long term, because they're gonna dilute, and the project is never gonna get built, so you have to basically time the cycles. Whereas, like, the best growth stories, they can go up even in a down cycle, which is very alluring to me, at least. And one test I think is really good. It's like, would you actually, if you had the money, would you actually be happy to buy out a company, take it private, or a project? Would you want to be an owner of whatever? There's not too many juniors I can say that about. It's like, when the rubber really hits the road, it's like, do you think you have a good business here? If you owned it, would you end up making money on it from a business perspective? I mean, there's a few. I mean, it's like Magna Mining, for example. That's one of few where it's like, okay, would I be okay to buy all Magna's projects, their competence, their management team, etc., take it private? Do I think that's a business, actual business? Yes, I think so. I think so. Whereas, again, most juniors are like, I don't know if they have a business. I have no idea when I actually, if I would get my money back. If I don't have anyone else to sell to, that's the point. If I'm the last buyer, would I be happy to acquire it? I get my value back from the actual business, not from selling to someone else at 3 to 4x the price where it currently is trading at. That's not a lot of ones you can say that about, because then you kind of need to, I really got to trust the management team. I really got to think they can create value. I really got to think it has value and all that. But that's one, I think, it really flushes out the trading sardines, at least. It's like, would you be happy to own personally buy out a low grade deposit in the middle of nowhere just because it's trading at $5 per ounce today? It's like, no, I don't think that's gonna be built in the next 20-30 years, or if ever. So that would be a money sink, in my opinion, even though from a trading perspective, yes, if it's trading at $5 per ounce, I probably could sell it for at least $30 someday. But that's a greater fool trading vehicle or play. Okay, I have one here as well. It's like, I mean, I'm putting this up because I know there's a lot of people who, well, most people don't make any money in juniors regardless of how long you give them. If you give them 8 years and they see a full cycle, they don't make money. Very few make money in a down cycle, which we've seen in the last 3 years, and that's nothing special. You're not a bad investor because you haven't made money in the gold space over the last 3 years. I mean, I think that goes without saying. Yes, there are a few companies that have done well and bucked the trend, but that's very much an exception. And like lately, for example, which we've all obviously, one second, which we've obviously seen is that alpha plays have been the only things that have worked really, and that teaches people to stick to alpha plays. Whereas I think, I mean, the risk reward has been increasing more rapidly for beta plays. Anyway, so if you like copper, for example, I mean, do you really? How much due diligence do you really need to make? Yes, I know that everyone is basically looking for. I want 10 baggers. I want them now and all that. But like, I think you can make incredible portfolios just from following stories with third-party validation. Yes, there might be crap junior X that's gonna outperform you from bottom to top and all of that, but it's like from our long term, if you were to I like copper. Okay, I don't know much about copper, but I think copper prices are going higher because of the EV trend or whatever, infrastructure spending, modernization of India, stuff like that. I mean, there's quite a few companies again with third-party validation that know what a good project looks like or a good target looks like, that have done infinitely more due diligence than any of us, and are also infinitely better at appreciating the due diligence. So in that case, I mean, how wrong can you go? Not that wrong. I mean, most people, I'm bullish on copper, and they finds the first shitty copper junior they can, and they're like, okay, this has copper in it. The management team says something about, well, this could be a major whatever, and they just pile in. Because I've seen a lot of people's portfolios, and there's not too many. There's a bunch of portfolios I look at where it's like, oh, I maybe would buy one of those 20 companies they own or something like that. It's mostly a bunch of, typically it's a bunch of random juniors where it's like, oh, they're bullish silver and they own anything with silver in it. And it's like, if you knew anything about the management team, you would be maybe like, okay, these are like really not seriously successful. They really put themselves first and all that. They have, I mean, there's nothing in their history which suggests that they know what a good project even looks like and stuff like that. And especially if you hold that for a long time, you're gonna end up losing. You're gonna make a lot of money if you're able to buy cheap and sell high, but most people are not able to do that, so that's not gonna save you. So it's like, I mean, there's like North Isle, I think has done well. I mean, Michael Gentile, he puts his money where his mouth is. I mean, Condor Resources with tech. Obviously, the Cobra is a good target. So it's obviously a high risk, high reward and all that. But still, I mean, just do stuff like that. I mean, if your portfolio only had juniors with third-party validation, yes, you might miss the gem, let's say. And some are obviously, let's say, fully priced already. It's like Philo Mining, that's obviously has Lundin and I think BHP or Rio Tinto backing. I think it's BHP. So is that a good vote of confidence? Absolutely. The Lundins are in it, BHP are in it, but it's like, yeah, but it's at 3 billion already. So I don't know how. I mean, it's well known right now. It's not underappreciated or anything like that. So it's not that oh, I mean, would I expect you to make money on it? Yeah. So I mean, from that perspective, it might be a buy as well. But relatively speaking, it might not be the best buys, because there might be, one would rather go into an earlier stage Lundin play, for example. But still, there's a bunch of like Faraday Copper, Lundin family, and Pierre Lassonde. It's like, do you know that their projects are gonna work? Like, no, but it hasn't really run. It has some of the smartest investors there are. It's like Hannon Metals got Tech and Jogmec. Inflection obviously with AngloGold Ashanti, and their technical team is just absurd. Alta Copper apparently has 40 SKU in it. So like, if you did a portfolio with 20 to 30 names spread across different commodities with like mostly third-party validation, from today, I don't think there's almost a chance you're gonna lose. But again, most people are not driven. They don't think it's good enough. Let's say if you get a double 2 years later, they want a double tomorrow. Especially when you see these alpha plays, that's been, some discoveries that's been rocketing 600% in 2 days. That's the stuff people are after, and they think they can. I mean, they think they can, actually pick those ones out easily. How many actually have gone up 500% in 2 days over the last 12 months? It's like what, 0.01%? It's like it's not. It is not as easy as it might look, and you don't need it. That's the thing. I think a lot of people shoot themselves in the foot because they expect outrageous returns, while they haven't really shown that they can have any returns over a longer period. Other stuff, just, I mean, since I've been digging into Sweden, especially lately, I mean, you start to appreciate, what makes an ounce in the ground valuable, for example. Here's from a presentation of a Nevada junior. It's in silver though, but you can see here like underground mining cost. Expectations are $83 per ton mine, processing $22 per ton, G&A $14 per ton. And then you look at a operating gold mine in Sweden, the Björkdal mine. Stoping cost $19.52 per ton. Process cost $10 per ton. G&A $5.59. I mean, it's like, 50% lower or more than, a Nevada junior assumes. And in Nevada, I mean, it's like it's not typically out in the middle of nowhere, and there's typically not that you have, we have to go through several mountain ranges to get there, and there you have ice roads and all that. But it just goes to show, I mean, there's a huge difference even, if you have good to great infrastructure and just simply where what jurisdiction there is. I listened to Joma Sundar talking about Finland, for example, which is, I mean, Finland is akin to Sweden. And he described that, you have projects in Finland that would not get built in Canada. They would not make profitable mines in Canada. But because Finland has good infrastructure and other stuff, it's a first world country, obviously. They have a lot of hydropower. You can make money on it. It's like the Kittilä mine. I think it has a grade of 4 grams per ton or something. It has refractory ore. And I think the ASIC on that one is like $900 or something. Just incredible. I mean, where else do you make money on that? Where else in the world? I mean, not many places at all. But Agnico is making big bank on that. And that's, in my opinion, why I think people are sleeping on... Finland is getting more recognition. I think people are sleeping on Sweden, because I think the same thing. I think basically Sweden and Finland are similar in that sense that they both have very cheap mining costs. I know Sweden has some of the most efficient mines in the world, for example, and this is an underground mine with a cutoff grade of 0.90 grams per ton gold. In Canada, in many places, you see like 3 to 3.5 grams per ton. It's just crazy how big of a difference the location can be. So one I really like right now at these prices is Red Pine. I've talked about them. They're a sponsor. So like I said earlier, Alamos has already taken out Manitou Gold. That's here. They recently took out Argonaut Gold. Here you have Alamos Gold. I think that's the Island Gold Mine. Here is the Vava Gold Project that belongs to Red Pine. So this now belongs to Alamos. This belongs to Alamos. This now belongs to Alamos. And your West Dome here, Angus Gold, Barrick, Silver Lake, Newmont, IM Gold over here. So obviously, it's like not the worst place to be. You obviously see that gold miners like this area. We know we've listened. You know, if you listen to Newmont and Barrick, I mean, especially I think Newmont said, well, the growth is going to be in Canada. So what I'm seeing is I think there is kind of a rush. I mean, it shows that jurisdiction is pretty high on the top of the priority list for gold miners. And Manitou was basically a gold land play. If I'm not mistaken, I owned it for a while, unfortunately not at the time of acquisition. But they had, a bunch of targets. They had a pretty big land package, but they didn't really have, as far as I remember, a resource. And I think it was, I'm not going to say remote, but it's like not not with the best infrastructure, not project-wide at least. So Alamos paid 17 million for Manitou, which was a land play back in 2023, I think. With gold at I think 1900. Red Pine are aiming for an updated resource in I think Q3, 1.5 to 3 million ounces, and yesterday it traded at 36 million. What would this be worth today? With today's gold price in a jurisdiction like this, with the kind of infrastructure they have. This is the town of Wawa. Patented claims. I think they have like mine permits or whatever it's called. So this is very much de-risked. Brownfield play in Canada, where there's been shown to, this is where mining companies want to be. Obviously, I mean, this is not out in the Yukon, like 50 kilometers to the closest road or anything like that. Here you would, airport here, this is where the people that works at the mine would live. I mean, the cost would obviously be a much less. And again, if that becomes a multi-million ounce deposit, it's not like that's the end all be all. I mean, we have no idea how much deeper this can go. This is a Canadian lode gold play after all, and orogenic gold deposits tend to go down to depth quite a while. This is the Alamos gold mine. It's not the highest grades in the current resource, but still, again, they will probably have a much lower cutoff grade than most Canadian gold plays simply because of the infrastructure. So maybe, let's say 5.5 grams per ton here is equivalent to 7 to 8 grams per ton in a place where their jurisdiction is lower. So they make as much money on 5.5 as another gold mine would make at 7 grams per ton gold or 8 grams per ton gold. I think this is simply, I mean, pretty absurdly cheap. And I mean, this is a 6 kilometer long corridor. They've shown that, you know, there's mineralization down here. We have no idea how big of a gold system this could become. And they're aiming for their next resource. And that's obviously just a snapshot at that point. They're aiming for 1.5 to 3 million ounces. Sure, that's a pretty good span, but still, I mean, let's say you get $100 per ounce. That's like, you know, 150 million to 300 million, and that's not at an absurd premium, and that's not accounting for the blue sky potential. So yeah, I think it's cheap. I mean, it's selling at 40 million right now. I mean, in my opinion, like I think 200 million is more reasonable than 40 million. Altamira Gold is quite interesting. Obviously, it's like a fairly large holding of mine. I listened to a talk with Tommy was interviewing Rick Rule, and he said that John Goodman of Dundee supposedly invested in Reunion Gold for the hope of finding only, you know, 500,000 ounces of gold in saprolites. That's the at surface, you know, free milling or free digging gold. Basically, you know, an erosional surface where the gold has been eroded from the hard rock source and now lies in gravel, basically. I think a lot of people are sleeping on this aspect of both Altamira and Cabral. We saw Osisco Gold Royalties invest in Cabral, and I think that has a lot to do with their saprolite discoveries, which they've been focusing on, the oxide blankets. I think everyone is sleeping on this because, I mean, the Reunion Gold story ended up being a multi-million ounce mine, hard rock mine now, so it's valued at 500 million or something. But still, I mean, if you look at it, like, so Dundee invested in hopes of them having 500,000 ounces because the margins of on the saprolite gold ounces would probably be at least twice a regular gold ounce, maybe more than that. And they ended up finding a multi-million ounce hard rock deposit. But again, the key takeaway is that saprolite gold can be very profitable. 1 ounce of saprolite gold might be worth 2 to 3 times as much as you know, most juniors hard rock ounces, and most hard rock ounces aren't really worth anything because you know, the deposit quality is too poor. So in a sense, I mean, 1 ounce in the ground to another, the difference in value could be, you know, almost infinitely, I was going to say. Some ounces might be actually worthless, and some might be worth $1,000 per ounce. And that goes back to my, you know, the idea of, you know, what's cheap at face value and what's actually cheap. So when you think about it, like for Altamira, how many gold ounces do you need in the saprolite to have a mining venture here? I don't know. I would expect capex to be very low. If there's like, you know, $1,500 gold margins today, if you have 50,000 ounces of that stuff, that's like, you know, 75 million in let's say pre-tax profits. That's, you know, worth pretty much let's say a bit more than the current market cap. That's quite intriguing given that they have 700,000 of hard rock ounces here, and Maria Bonita could be potentially you know, pretty good intrusion deposit. I mean, if they get 1.3 million out of Maria Bonita, they have 2 million ounces here already, plus the saprolite, and they have a bunch of other targets which might have saprolite plus hard rock potential as well. And this is a picture of one of many projects in their portfolio. They have porphyry targets as well. So I mean, based on the sum of its parts and the risk nature of starting with 700,000 ounces. Maria Bonita, we don't know how big that will be. We know what they've hit so far, which looks good. So there ought to be some, something there. I mean, I just think it's in my opinion, a huge value play, and maybe especially because people are sleeping on the Saprolite potential. I was gonna have this to on the point of red pine, because we heard Quentin kind of describe red pine as hey, this could be another great bear, and then it's like, well, it's people don't trust it because the stock hasn't been performing that great, but when you think about it, it's like, okay, Great Bear, when they did the 2019 resource, 2.7 million ounces of 2.57 grams per ton. I mean, most of this is, I think, open pit though, so that's one thing to keep in mind. But in total, 5 million ounces, but that's from 409,000 meters of drilling. I think they were up to like 5 rigs. And today, Kinross has drilled 550,000 meters. So I don't know how much Red Pine has drilled, including the historic resource, but I bet it's not even not anywhere close to this. So imagine if they've drilled, I don't know, let's say 100,000 meters or 150,000 meters, and they're up to 1.5 to 3 million ounces. I mean, yeah, that they can legitimately, with as much drilling as Great Bear, they could have something that is Great Bear sized. I wouldn't rule it out. I'm not saying it's the next Great Bear, but you get my point. Because that's, I think, something that a lot of people, might be missing. It's like, well, Great Bear did whatever. It's like, yeah, they had 5 drill rigs going. They spent, I don't know, $100 million on drilling or something. That's how it became Great Bear. But if they had 1 rig and just prodding away, it's going to take a while to show a Great Bear type deposit, even if it's there. Oh yeah, okay, so here's the Altamira presentation. Again, we don't know. We're waiting for results out of Maria Bonita. Looks very promising. Here you have the soil anomaly with the magnetic anomaly. And this is basically how they're kind of carpet bombing it. I don't think they can see the mineralization, so it's like impossible to tell. Not impossible. I mean, they can see signs, given that they added a second drill rig, but it's like I don't think they can really tell when they are in potential or not. But it might look very interesting, and also that there's I don't think if they have that here, maybe. But I think there's like a secondary intrusion, for example, that's kind of barren, that's cuts through some of these holes. Okay, they don't have any of those slides here. My point is, I don't know what this drilling is going to show. It's hard to trace because they don't see, there's, I think, no VG or anything like that. But I think it's at least going to give them a lot of information. I would be very surprised if they didn't hit anything. But I think they're going to have a sense of, they're going to know a lot more about this system after this drilling. So it's like I expect the hit rate to get better, given that they have more information after this. Kind of like alpha exploration, where it's like they think they have solved, they think that how the system behaves, they think they figure out the controls, etc. down there in Eritrea. So I expect the hit rate to go up. Oh, here was the interview with Rick Rude, where he talked about the saprolite gold potential. Dundee back reunion confident the drilling underneath the trenches would yield 500,000 ounces of saprolite gold fine, and lo and behold, it became a 6 million ounce beautiful asset. That's kind of the way this business works. I'm not saying that's gonna happen, but again, it's like both Cabral and Altamira, they are they're well aware of the saprolite potential. And if you look in, the quote, for example, from the presentation, I could find the problem. Where is that? That is, I think there's a code in here somewhere. Here, yeah. Following the earlier excellent result from the initial agitated tank leach metallurgical test work where over 90% gold recovery was achieved, these new column leach test results indicate that the Saprolite material at Maria Bonita should be highly amendable to heap leaching, giving the zero to very low strip ratio of their central part of the mineralized area drilled to date. We now have a sound technical rationale to develop studies on a very low capital intensity startup option on the saprolite mineralization. As we progress the current round of diamond drilling, we will further evaluate both the saprolite and underlying primary mineralization to identify options to generate early cash flow. And of course, you can look at who cares. Well, Aura Minerals, which is a legit mining company invested in Altamira, they're probably very much aware of this, the saprolite potential, and that also goes for Cabral, which got Cisco Gold royalties. But us retail shareholders, do we have any idea what saprolite gold is? If somebody says, well, 100,000 ounces, like let's say the saprolite ends up being 100,000 ounces, it's like, oh well, I can buy 3 million ounces in Canada for whatever. It's like, yeah, but actually these 100,000 ounces might, make more money than, or be a better business than 3 million ounces out in the middle of nowhere at low grades, if you know what I mean. So I think people are sleeping on this, and I mean that kind of includes myself, because we haven't seen if I think Cabral is working on a PEA, for example, on the oxide, the saprolite potential. I mean, imagine if that comes out with 150% IRR, NPV of 200 million or something, capex of 20 million. I mean, I think people are going to wake up in that case. So that's also obviously stuff one would want to front run. It's like, look where people are not looking, appreciating stuff that's not appreciated right now, but with the right catalyst, people will appreciate it and stuff like that. Stillwater Critical Minerals, they're raising more money with a lead order from Glencore, the $80 billion company. Sometimes I get irritated with how, let's say, unfair people can be. It's like, okay, they announced this, yes, it's dilution, because that's what a raise is. So it's like it shouldn't come as a complete shock. They have had it in their presentation that they were gonna raise money, but it's like diluted to hell once again. What a joke this management team is, and it's like horrible management. The market is not dumb. Zero pop on this news. My response to this, like, first of all, it's like 10% dilution on a 30 million market company, when a $80 billion company is doing the investing. It's like, it's like people. I'm not saying that, let's say, the management team couldn't have done anything better, but it's like, look around you. The Sprott Nickel Miner ETF is down, 45% since October of last year or something. This is a chart of a Sibanye Stillwater. It's down 78% in the last 2 years. I mean, it's a fire sale in this sector, and the juniors tend to get hit the hardest. So it's like, the short is down. What a horrible management team. It's like, then you don't know anything about how this sector works. I think it's a pretty good job to have been able to attract the ex-head geo of Ivanhoe Mines, who were responsible for the exploration down in the Bushwell complex, which they think this is analog to. If they attract people like that plus Glencore, you're probably onto something. You probably were very smart to buy up all this ground. And you probably have a lot of potential, because the Ivanhoe ex-head geo, he's in it for the exploration potential, obviously. They kind of scratched the surface so far. So I don't know what's going to change, sentiment, whatever. But it's like, I mean, it just goes to show. I mean, how this market works. Nobody cares until they all, people really care, whatever. And so far, yes, right now, everybody hates nickel plays. Everybody hates PGM plays. Palladium has gotten shit canned basically. But still, if we take a long term perspective on an asset like this, who cares? Glencore cares. They're an $80 billion company. They're some of the, they pretty much deemed the smartest of smart money in a sense. You have again the ex-head GEO of Ivanhoe Mines. Like, it doesn't get much bigger than Glencore and doesn't get much better than an ex-head GEO of Ivanhoe Mines. Is this market cap reflecting that? No. Who's driving the bus here? Well, it's retail shareholders. And the sector has been absolutely canned. Is this cheap? Yeah, I think this is very cheap. They own a very large asset in a mining camp, because Sibanye Stillwater is right next door, and this could be, who knows how big this could be. I mean, they literally scratched the surface. This is what, 12, I think it's like 12 kilometers or something. This is a 15-kilometer trend. It's wide open. It's wide open between the deposits, and it's wide open at depth. I mean, they're far as I understand, I mean, you could have something spectacular at depth, for example. This could get huge, but right now, large, let's say, lower grade. Well, they hit high grade as well. That's the funny part. I mean, there's high grade structures in there. They have some really, really good high grade intercepts. So it's very much up in the air. You could probably make a high grade deposit out of this. Drill out the high grade structures. You can have a huge tonnage lower grade deposit here, and it's still wide open. And they have more projects as well. It's like, all I know, it's obviously cheap. That's all I know. When the market will care, I do not know. Will it be, the sector overall that get, nickel goes back up again, and PGMs rebound as well, like Rick Rule is expecting over the next couple of years? I don't know. Will it be they do I don't know, put in a hole that hits, some kind of feeder again? I don't know. I just know it's cheap. I have no idea where Stillwater is gonna trade in the short term, or when people will care about it being cheap. So that's the unfortunate kind of cycle sometimes of like these juniors, that when the momentum is out of the sector, they have a hard time proving how valuable they are. And that makes it look even more boring, which makes the discount even larger and all of that. That's why this sector goes up 500% and down 90%. One other tidbit which is kind of interesting. There's a company called Ramp Metals. They have one of the technical advisors is Dr. Mark Bennett. I've actually met Mark, a really stand-up guy, is my impression. So he founded Sirius Resources, acquired for $1.8 billion, and oversaw the development of the Noah Bollinger nickel copper mine in Western Australia. Okay, so this company has staked the southern edge of Fathom's Albert Lake project. And they even say that, where is it? Grade of Rottenstone mine points to a much larger regional system, need a very large volume of mafic, ultramafic material to produce these grades, much more than the small pod where the deposit is found. That's basically what, and here you have, this is Fathom's land package, this is ramp metals. That's basically what the Fathom nickel team has said. So, that's obviously a vote of confidence if you have Mark Bennett involved, and they stake the extension of the Albert Lake project. Fathom Nickel has, I think it's down to a 9 million market cap company. I think that's cheap as well. I mean, based on gold checker alone, I think it's cheap. But these guys are also saying, and Fathom says that as well. It's like there ought to be. I mean, there must be something bigger here because of the very high grades up here. Where is that? Is it on Fathom's ground? Is it on Ramp Metals ground? I don't know. But obviously, in a sense, I mean, it would suck if in a sense that, okay, if there's, let's say there's only one good deposit here and it sits on Ramp Metals ground. Yeah, okay, that wouldn't be good. Obviously, I think Fathom would get a big boost if Ramp Metal drills and hits here, because that kind of, I think, would spill over to Fathom Nickel, because it's obviously the biggest closeology play, or it might be in Albert Lake, but we haven't found it yet. So I don't know. I mean, how to, let's say, view this. I mean, Ramp Metals obviously thinks that they might have the source to this, let's say, what there got to be a big source, let's say, to create those kind of grades, and maybe it is down here the source, and that's the end all be all, or the source is at Albert Lake, and or there might be multiple deposits. No idea. It's just an interesting thing. And again, if you see Mark Bennett show up, it's like, okay, I don't think he doesn't strike me as the guy who just puts his name behind anything, let's say. I think it's speaks well of this area, at least for nickel potential. So Fathom Nickel. And here's just an example. Like, I actually participated in this private placement, and this is strategic investors. So here you have, where is it? Evanachan Limited. That's controlled by Robert McEwen. And this is what I'm talking about. This got to be, I don't know, the 5th Canadian gold junior I've seen him invest in the last 12 months, something like that. He's obviously a pretty big investor in Goliath, for example. So I mean, I'm looking at what these rich folks are doing. It's like McEwen seems to be buying into every high-grade Canadian load gold play. And going back to my point, gold is rare and all that, but it's like good projects in the jurisdictions where it's like, I mean, it seems that the larger miners are very keen on Canada, and that speaks to, I mean, I think they're looking at jurisdictional risk, and when you see what happened in Panama, for example, you can't blame them really. And of course, I mean, again, if we're stealing legitimate value right now, if we're like, oh, I'm buying assets at fire sale prices, if I get to keep the assets, if I'm almost 100% sure I get to keep the assets, then that's obviously worth something. Otherwise, it's like, hey, let's say we take some, I don't know, Latin American or African jurisdiction where it's like, okay, yeah, well, this looks really cheap. I think this has a lot of value. You buy it, and it's like, oh, the government also think it's really cheap or really valuable. So one day you end up, it's like what you bought for pennies on the dollar, something stole, and you get paid nothing, if you know what I mean. So I am putting an emphasis on jurisdiction. Because it makes, it's easier to sleep. It's like I know some of these jurisdictions, like nobody's gonna steal your deposit or mine. And how much is that worth? Let's say you have you find something with a 20-year mine life. If that's your assets for 4 years, maybe it paid itself back. But it's like to capture the full value, monetize it fully. If it has a 20-year mine life, it means you get to be able to own it for 20 years. Yeah, so last point on that. Already a long rant. I'm getting tired. Thanks for listening. Consider me biased. This is not investing advice. The juniors I talk about, I own many of them. Some are banner sponsors, so I'm twice biased. I'm just, airing my 2 cents here, and I think it's something to maybe at least generate some ideas and some concepts to think about that I think have merit. But it's like no, you don't have to agree with me on anything. It's like you are the only one that will be, accompanying yourself in your investing journey at every single second. So if you don't understand why it's like, oh, why should I buy this, and volatility hits and you bought it and you have no idea what to do, it's like you can't transfer conviction. Only you need to have the conviction. You need to have a game plan. And again, it's like, even for myself, I might get an impulse, whatever, and then at the same time it's like, oh wait, I know how I'm gonna react if whatever happens. There's like, okay, I'm buying this, now it feels good to buy this because metals are up. And then I forget the fact that, well, if metals trade down, I'm probably gonna sell low because I don't really know why I bought something. Stuff like that. I mean, it's just gonna come back and bite you. Anytime in my opinion where your case is not based on the next at least 6 to 12 months at least, I think you're doing yourself a disservice. But most people obviously buy because they think something, oh, I'm buying this because it has gone up and I think it's gonna go up in the short term. Because let's face it, let's say gold is here. We have no idea how the chart is gonna, we can't see the future. So I want a portfolio basically where I'm comfortable if gold does that or gold does that. If I just plowed into pure trading sardines, where I don't think the product really has much merit, how am I gonna feel and act if gold does this? Will I end up selling here because, like always, we project what has happened forward because I start to think it's gonna go like that? So I get shaken out, let's say, and then gold does this because it was a retest. In that case, I'm gonna cement a paper loss here just in time for it to go up, and I should have been buying here, but because I didn't have any conviction, I was short-term focused, I didn't have really a plan, things might end badly. And that's what I think the biggest mistake people do, is exactly that. But if I instead bought companies where it's like, okay, I know what I'm paying here today, I think they're worth up here already, So I think you have a discount to real value. I think the value is going to go up. Oh, okay, pretty long, but it's like I think it's going to climb higher over the next couple of years. If I'm paying here this price, I think it's worth this and going to be worth that. Who cares if gold goes down? Maybe let's say gold goes down, value goes down there. It's like short term, just in relation to current gold. Price goes down here. Well, that's still a fat buy, because this is the price to current value gap at that point, and this is the price to future value. So it's like it's a no-brainer buy. It's a buy. It's a buy more kind of case. That's a plan. That's a strategy. You know why you bought. It's long-term focused. You have the conviction because you're in your mind. You know it's worth this much, or you know I'm gonna make money on this. If price goes down, I'm gonna make more money. Completely different than being, short-term focused with no plan, just sitting in pure trading sardines with no conviction. As soon as gold goes down, maybe the price in the juniors go down, and you're like, oh, I don't know what to do anymore. Now I'm scared it's gonna go like that. That what I own, that I don't have any conviction in really. I'm just fearing a price decline. While you should be buying because you're looking at value versus price, not guessing where price is gonna go in the short term. If you get my point. Yeah. Anyway, thanks for listening. Bye.